everyone is watching the wrong room. Right now, while cameras are pointed at diplomats shaking hands in Islamabad, the real meeting already happened, and you were never supposed to find out what was decided there. These talks are not a peace process. They are a performance. And by the time you finish watching this, you will never look at your grocery bill, your fuel costs, or your savings account the same way again. Let's establish something the mainstream narrative refuses to touch. The US-Iran talks in Islamabad were announced as a breakthrough, a historic diplomatic effort to de-escalate tensions in the Persian Gulf and pull the world back from the edge of a major conflict. Every major outlet ran the story. Every pundit praised the maturity of the parties involved. The UN issued a statement of cautious optimism, and the markets briefly exhaled. That exhale, that moment of collective relief, that was the trap closing. Because when the public stops watching, the machinery keeps moving. And right now, that machinery is pointed at the Strait of Hormuz. Here is the anomaly that no one in a major newsroom has bothered to connect. 3 days before the Islamabad talks were formally announced, shipping insurance premiums for vessels transiting the Persian Gulf spiked by 34%. Not after the announcement, before it. War risk insurance, specifically the Lloyd's of London Joint War Committee coverage for Gulf routes, moved significantly upward in a window that precedes the public diplomatic calendar by nearly 72 hours. Ask yourself a simple question. Who knew the talks were coming before the press release dropped? And why, if these talks represented genuine de-escalation, did the people pricing risk for the world's most critical shipping lane move in the opposite direction? This is not a coincidence. This is a signal. The financial infrastructure that underpins global trade does not lie the way politicians do.
Freight derivatives, tanker spot rates, oil futures positioning. These instruments are priced by people whose money is on the line. And in the weeks surrounding the Islamabad announcement, the smart money was not pricing in peace. It was pricing in obstruction. Container shipping indices showed elevated volatility on Gulf-adjacent routes. Energy traders were quietly accumulating long positions on Brent crude in a pattern that mirrors, almost surgically, the positioning that preceded the 2019 Abqaiq strikes. The retail investor saw diplomacy. The institutional money saw something else entirely. Now we need to talk about the Strait of Hormuz. Not as a geography lesson, but as a financial weapon. Approximately 20 to 21% of the world's oil passes through this 33-kilometer-wide choke point every single day. Roughly 17 million barrels. When you add liquefied natural gas, the number becomes even more staggering. Nearly a third of globally traded LNG moves through that corridor. This is not just an energy story. This is a supply chain story. Because the moment that strait becomes contested, the cascading effects do not stop at a higher petrol price. They ripple into fertilizer production, which drives food prices. They ripple into plastics manufacturing, which drives consumer goods prices. They ripple into air freight costs, cold chain logistics, pharmaceutical supply routes. A sustained closure of the Strait of Hormuz, even a partial, ambiguous closure, where insurers simply won't cover the route, functions like pulling a single thread on a sweater knitted from the entire global economy. And here is the part that should make you sit very still. A prolonged inflationary shock of that nature does not hurt everyone equally. It devastates wage earners, small businesses, and anyone holding cash savings in a depreciating currency. But it is extraordinarily profitable for a specific class of actors. Commodity traders with pre-positioned long exposure. Sovereign wealth funds with energy-heavy portfolios. Private equity firms holding infrastructure assets priced in real terms. Defense contractors whose order books fill the moment a Gulf incident escalates past a certain threshold. Hedge funds running macro strategies specifically designed to profit from supply shock inflation. These are not abstract villains in a conspiracy theory. These are named entities with documented positions, quarterly filings, and lobbyists who attend the same conferences as the diplomats currently sitting at that table in Islamabad. To understand why these talks are designed to fail, you have to look at what happened 3 days before they started. But you also have to look at what happened 6 months before that. Because this story did not begin in Pakistan. It began in a series of closed-door sessions between central bank governors and a handful of sovereign wealth advisors who have been grappling with the same existential problem since 2022. The problem is this. The post-pandemic inflation cycle was never fully unwound. Consumer price stickiness in Western economies remains structurally elevated. Real wage growth in the US and UK is either flat or marginally positive at best, not enough to restore the purchasing power lost between 2021 and 2024. Central banks have exhausted the conventional toolkit. Rate cuts are politically costly and inflationary in themselves, given the debt load most Western governments now carry. What the system needs, from the perspective of those who profit from volatility and asset repricing, is a new exogenous shock, one that justifies a fresh round of monetary policy emergency measures, unlocks government spending in the defense and energy sectors, and creates the kind of price chaos in which real assets dramatically outperform financial ones. The Strait of Hormuz is not a problem for that agenda. It is the solution. Now watch how the Islamabad framework fits perfectly into this architecture. The talks are structured around a precondition that both sides know is impossible to meet in the current political climate. Iran cannot unilaterally dismantle its nuclear enrichment program without triggering a domestic political crisis that would remove the current government. The US cannot offer sanctions relief significant enough to satisfy Tehran without facing congressional opposition that would stall the process for months. Both sides know this. The diplomats in those rooms are not stupid people. They understand the gap between what is being asked and what is politically survivable. So why are they there? Because the talks themselves are the product, not the outcome. The announcement buys time. The optimism narrative suppresses market volatility just long enough for the positioning to complete. And then, when the talks collapse, as they are designed to, the escalation narrative resumes, but now it is worse, because a failed peace process is always more dangerous than no peace process at all. Failed diplomacy is not neutral. It creates permission structures. It shifts the Overton window. After Islamabad breaks down, every hawkish actor in the region has a ready-made justification. We tried, they refused. And the strait begins to tighten. Consider who benefits from the specific timing of this collapse. If talks fail in the next 60 to 90 days, the impact will land directly on the third and fourth quarter economic cycle in both the US and European economies. Supply chain disruptions feeding into Q3 and Q4 earnings will accelerate the rotation out of tech and growth equities and into commodities, energy infrastructure, and defense. Pension funds, which are structurally required to rebalance toward value assets in a high volatility environment, will mechanically shift hundreds of billions in capital. That capital does not disappear. It moves. It moves into the hands of the institutional class that was pre-positioned before any retail investor heard the word Islamabad. This is what a wealth transfer looks like in the modern era. It does not look like a heist. It looks like geopolitics. There is one final layer here that most analysts are missing entirely, and it is the most important one. The Islamabad talks are happening in Pakistan, a country that is itself sitting on a financial knife's edge with IMF program dependency, a currency that has lost catastrophic value over the past 3 years, and a military establishment that has historically functioned as a broker between Gulf state interests and Western intelligence frameworks. Pakistan is not a neutral venue. Pakistan is a venue that is owed favors by multiple parties simultaneously. The choice of Islamabad as a location is not logistical convenience. It is a message to a specific set of regional actors about who is underwriting this process and what they expect in return. When you map the financial relationships between Pakistani sovereign debt holders, Gulf state sovereign wealth funds, and the private equity networks that have been quietly acquiring distressed infrastructure assets across South Asia over the past 4 years, a picture emerges that has nothing to do with nuclear de-escalation and everything to do with locking in the economic architecture of the next decade before the public understands what is being built. That is the illusion. The Islamabad talks are not negotiations. They are a stage set. They are a precisely engineered pause in a process that was never designed to end in peace. Because peace in the Persian Gulf, stable supply chains, and predictable energy prices serve the wrong people. They serve you. They serve the small business owner paying freight costs. They serve the family absorbing food price inflation. They serve the pensioner watching purchasing power erode.
And the system that has been built over the past 40 years of financial engineering and geopolitical theater is not optimized for any of those people. It is optimized for the people who already own everything and are now in the process of buying the rest at crisis prices. The talks will fail. The strait will tighten. The inflation will return harder this time, and the policy response will again reward asset holders and punish everyone else. You already know this somewhere underneath the reassuring headlines. You feel it every time you look at what your money buys today versus 3 years ago. The only question is whether you understand the mechanism well enough to stop being surprised when it happens again. If this channel is the only place you heard this framing, that tells you something. Subscribe, because the next chapter of this story is already being written, and you are going to want to know what it says before the rest of the world finds out.